Good day, and welcome to our webinar, Understanding the Power of the Personal Pension Plan. We have divided this presentation into 3 chapters, so depending on your time, you can watch all 3 chapters today or spread them out. Chapter 1 is Understanding the Power of the Personal Pension Plan. Chapter 2 is a case study on an average business owner. And Chapter 3 is using a personal pension plan to your advantage in the stock market corrections. I am Stephen Friedman, and I'm so excited to have a special guest with us today, Jean-Pierre Laporte, who is a specialist in Canadian pension law and the recipient of the Queen Elizabeth II Diamond Jubilee Medal in recognition of his various contributions to the development of new forms of Canadian retirement savings plans. For those of you who are not familiar with this award, it was created in 2012 to mark the 60th anniversary of Her Majesty Queen Elizabeth II's ascension to the throne as the Queen of Canada. The Queen Elizabeth II Diamond Jubilee Medal was a tangible way for Canada to honor Her Majesty for her service to this country. At the same time, this commemorative medal served to honor significant contributions and achievements by Canadians. Now, just before I introduce Jean-Pierre, besides welcoming you here today, I would like to congratulate you on taking action and making a great decision to attend our webinar, where in the next 45 minutes, you will learn how to build the largest retirement nest egg as possible while claiming the largest tax deductions. Now, who is this for? Incorporated Canadian professionals such as doctors, dentists, lawyers, accountants, franchise owners, and consultants. In 2020, Canadians are allowed to contribute up to 18% of their 2020 pre-tax income up to $27,230. So for someone earning $150,000, 18% of $150,000 works out to $27,000. The majority of Canadians earn less than $150,000 annually, so the maximum RRSP limit in 2020 of $27,230 is sufficient. But what about people earning over $150,000 and those earning over $250,000 or $500,000 or more? A tax deduction of $27,230 for their RSP contribution is nice, but tax deductions through an RRSP is absolutely nowhere near what they would be receiving if they had a personal pension plan. And on that note, it gives me great pleasure to introduce one of the most respected lawyers in Canada, Jean-Pierre Laporte, who will open your eyes to the numerous advantages of a personal pension plan. Take it away, JP.
Well, thank you, Stephen. And welcome everyone to this first chapter on understanding the power of the personal pension plan. What we want to discuss today is the smarter use of pension laws in order to maximize corporate tax deductions. But before I get into this piece of the Income Tax Act, let me start out by saying that the PPP is a combination registered pension plan that's governed by Section 147.1 of the Income Tax Act. The PPP, or Personal Pension Plan, is a stable, creditor-protected solution that allows incorporated Canadian professionals, and here I'm thinking of doctors, lawyers, accountants, franchise owners, consultants, to reduce their risks and to increase their wealth by enjoying superior tax advantages that are permitted under pension legislation. The CRA has approved the PPP. In fact, the Registered Plans Directorate of the CRA, the Canada Revenue Agency, requested of Integris that it submit its plan design for specimen approval. This is to automatically approve all PPPs as soon as they're filed, much like how it's done with an RRSP declaration of trust. You should also know that no PPP has ever been denied registration by the government, no PPP has ever been audited, and no PPP has ever been challenged in tax court or regular courts. Now, how do we maximize corporate tax deduction? Well, the PPP offers a simple mechanism to transfer corporate pre-tax assets into a tax-sheltered pension plan without having to expose this cash to punitive personal tax rates. Pension legislation offers a number of tax deferral techniques that simply do not exist with RSPs. In the next few slides, we'll be showing you how the RSP stacks up against the PPP. So when we're comparing the two alternatives, or the alternative, I should say, that we have, the RSP on one side and the PPP on the other, let's look at what we're allowed to do. So with an RSP, as Stephen already said, this year we have a maximum contribution limit of $27,230, and that's shown on the left. But with the PPP, we can put more money each year. In fact, when we're young, we can put $600 more, and as we get older, we can put as much as $18,000 more than the $27,230 RSP limit. So that really adds up over time. Plus, we can do a buyback of past service. So if the company was paying salaries in the past, we can retroactively purchase all those years that the plan wasn't in existence and add them to the formula so that we can get a corporate tax deduction to buy back this past service. In the first year, we can also do an RSP contribution. We call that the RSP double dip. And the size of that double dip will depend on a few factors, but it usually ranges between $6,500 all the way to $26,000 and change. Now, because this is a true pension plan, if the rate of return on assets inside the account is under 7.5%, we are allowed to do what are called special payments. And these are also tax deductible to the business that's sponsoring the PPP. Unlike an RRSP, with a PPP, the investment management fees are tax deductible. That can also add up quite a bit over time. If the company that sponsors the PPP decides to borrow money from a lender in order to contribute it to the pension plan, the interest on those borrowings is also tax deductible to the business. Now, if a business owner decides to turn on the pension benefits before age 65, even if they continue working for the business, instead of taking a salary, they would now start drawing a pension from the pension plan. But in order to fund early retirement and index that pension benefit to the cost of living to inflation, and also to ensure that the early retirement benefit are not reduced, we have to make a special payment called terminal funding. And this terminal funding can be quite significant. I have $800,000 an example, but in many cases, we've seen these numbers go as high as $2 million. In addition to all of these, we also have in subsequent years, after the first year, we have what's called the pension adjustment offset amount. So that's another $600 of personal tax deductions that can be claimed by the PPP client. We also have the ability to claim the GST or HST pension entity rebate program that provides a refund from the CRA of 33% of all the sales tax that's been paid in connection with the pension plan. Oh, we can also do pension income splitting, and this as early as age 50. So for example, if you had a $100,000 a year pension payable out of the PPP, by being able to split that with a spouse and only declaring $50,000 on one's tax return and the other $50,000 on the spouse's tax return, the couple on average for a $100,000 pension would be saving about $6,000 in taxes every single year. And if that wasn't enough, both persons in the couple can claim $2,000, so $4,000 for the couple, in annual pension amount deductions. This is a non-refundable tax credit that's claimed on your personal tax return. And this can be started as early as age 50. We have to be at least 65 to do the same thing with an RSP RIF. So my question that I've always asked people is anyone ready for an upgrade? Which of those two solutions do you think you should be utilizing if your intention is to tax shelter as much money as possible? Fortunately, 98% of Canadians are using the RRSP, and only 2% of business owners have discovered the PPP or pension plans of that nature. Now, what about fees? Well, of course, because you can put more money in a PPP than in an RRSP, as you can see on the graph below, over time, you're going to end up with more money. And in this particular example, it's a 45-year-old accumulating money over time. By age 65, or 66, I should say, this individual has over $1.1 million more in terms of registered dollars available for their retirement than if they had maximized their RRSP every year. And this assumes the exact same rate of return on assets. So what would you expect to pay in annual fees to be able to increase your retirement fund by over $1.1 million? What would be a fair amount of fees? Would it be $10,000 per year, $15,000 in order to get that $1.1 million extra? Well, the answer is $2,800 plus, of course, HST. But remember that this annual fee is tax deductible to your company, so the true cost is a little bit less than that. So just to conclude this first chapter, we know that Canadian business owners, and I again repeat here, the general suspects, your doctors, dentists, franchisees, lawyers, accountants, all of these Canadian business owners have a choice that others do not have. They can rely, of course, on the RSP system, and we've already talked that 98% of Canadians do this when they're using a tax-assisted plan, or now they can upgrade to the pension system using all the extra tax deductions that we discussed. And that's 2% of Canadians who discover these rules. So my choice, my question for people is, which one should be using? Because we know that the PPP has significant tax advantages over the RRSP. So if you have any questions for this first chapter, you should feel free to email your questions to Stephen at his email address shown here. So let's move on to chapter 2. And this is a case study. So under this case study, Claude is a small business owner or a franchisee or an incorporated professional, doesn't matter. And Claude wants to build the largest retirement nest egg as possible while claiming the largest tax deductions along the way. So let's look at some of the facts. Claude's 45 years old. His business has paid him T4 income of $125,000. He's been in business since 1995. The company typically always paid that kind of compensation. By now, he's been able to accumulate $400,000 in RRSPs. Now, Claude is a fairly conservative investor, and he's happy with picking a basket of funds or stocks that will ensure a return of 5% and no more. He's not going to take extra risks just to get a higher return. He's also averse to paying taxes, so he's going to retire as late as possible from his business. He's going to retire at 71. And because the company has done well for itself and is earning more than $500,000 of taxable income a year, the company pays corporate taxes at a rate of 26%. So when we do a projection or an analysis of someone like Claude, we produce a report, and the first page of this report is the executive summary. And this is kind of what it looks like, and it gives you the big picture. So in Claude's case, the PPP has been able to enhance the registered assets that are available by age 71 by $1.6 million. So all else being equal, we first start with what an RSP could have delivered if we maximize the contributions every year. And then thanks to the pension rules, we're able to bump that up by $1.6 million for retirement purposes. So graphically, when you look at it, you can see that as he gets older and as he's allowed to put more and more money towards his retirement using the pension rules, obviously there's a big gap that starts to grow. And by age 71, it's over $1.6 million, in fact. But how is it possible? How can it be that pension legislation would allow you to put that much more money than under the RSP rules, because we're assuming he would have maximized his contributions to an RRSP. And how much can he put? Well, if you look at the executive summary, the first column is called additional PPP contributions above RSP contribution, and the answer is he's allowed to put $733,000 more than the maximum RSP contributions possible. So the next question is, well, what are the sources of these extra contributions? How do we get to this $733,000? Well, the first thing we look at is on an annual basis, his current service contributions, which is the left column. You can see that they're always higher than the RSP amounts permissible for that year. So for example, if we were to pick a year at random, the year 2033, you can see that he's allowed to put $48,480 in the PPP, whereas at that same point in time with RSP rules, the most he could put in is $32,080. So that's $16,400 more just in that single year that is contributed to the plan, which of course triggers more tax deductions. And that extra $16,400 is going to grow tax sheltered for many years into the future. And the process repeats itself every year. Now, that's not enough. That's not the only thing. In addition to being able to contribute more every year, every 3 years, because the assets are not growing at 7.5%, we told you that they were growing at 5%, we have underfunding developing inside the plan, which gives Claude's company the ability to make extra tax-deductible special payments. And if you look at this column, called the past service contributions, you can see that every 3 years, there is another amount that's being added to the pension plan. And those are the famous special payments. Now, we're also allowed to do some personal tax deductions if that wasn't enough. So in the first year, we have the double dip. We talked about the fact that you can contribute to an RSP in addition to the PPP in year one. So in the year 2020, there's a $14,500 personal tax deduction. And then in subsequent years, there's the little $600 pension adjustment offset amount that we alluded to under Chapter 1. So when you add all of these up, you end up with $733,000 more than what would have been permitted under RSP rules. So now it's understandable that this money will balloon into $1.6 million more. But there's more, because if Claude decides to retire before age 65, remember we talked about terminal funding. Well, terminal funding is also possible. And if you look at the right-hand column of this chart, you can see that there are a number of different terminal funding opportunities depending on the retirement age selected by Claude. So let me explain what I mean by terminal funding, because this is a term that we don't really hear very often. So let's assume that Claude decides to retire at age 58 instead of waiting till age 65. So if you look at the terminal funding table for age 58 in the year 2033, you see that he's entitled to an annual pension of $99,438. So that's what would happen normally. But if his company has the cash available, or maybe a holdco or some other company that he owns can lend the money to the operating company, if he has over $1 million that he wants to tax deduct, he can contribute it to the pension plan via the terminal funding rules. And what does that do? Well, that means that instead of retiring on a $99,000 a year pension, now at age 58 and for future years, Claude can collect an annual pension of $170,000, almost $171,000 a year. So that's an addition of $71,456, more than what he would normally be allowed to receive. That's 72% more pension starting years before age 65. So that's what the $1.023 million is being used for, is to upgrade the pension years before he's normally entitled to receive it. And of course, as a bonus, because the $1 million terminal funding amount is tax deductible to the company, the company just pocketed a tax savings of about $266,000 because it's being taxed at 26%, as we discussed when we talked about the facts. So is there more than all these deductions and possibilities? Well, there is, because the investment management fees are also tax deductible to the company. Now let's assume that to manage the assets of this plan, the cost adds up to about 2% of assets under management. So let's, again, walk through a numerical example. We're going to pick the year 2030. And in the year 2030, we know that the assets under management are $1.5 million. And if we've decided that the cost of managing those assets is 2%, then that means that the fees for that year is $30,000. But since the $30,000 is tax deductible to the business, and since the corporation pays tax at 26%, in effect, Claude's company has just saved about $8,000 in taxes. Well, that's very interesting because $8,000 in tax savings is almost 2.5 times the annual fee to run the program. So just using this single tax deduction, forget about all the other ones we talked about, just being able to write off the investment management fees means we've already paid for the cost of the program over 2 times, sorry. So if you're interested in what that means in terms of using this investment management fee tax refund over the entire time frame, what we've done is we've tracked the assets under management each year. We've imposed a 2% investment management fee, and then we've calculated what that turns into in terms of tax savings or tax refund. Then we subtracted the annual fee, and we end up with a surplus of net after fee. So you can see that even in the first year, the plan is already self-sufficient, meaning that the tax savings pay for the cost of the program. And of course, leaves a lot of money behind for the client to enjoy. So the next question is there more than all of this? Well, believe it or not, there is, because we decided here that at age 58, Claude would be taking a pension of $170,000 through terminal funding. Claude happens to be married, so he's also allowed to do pension income splitting. What would that mean? Well, it would mean that Claude would only declare income on 50% of the annual pension, meaning on $85,447. However, his spouse would have to also declare that $85,000 on the tax return of the spouse, and both parties in the couple would have to pay tax on those $85,000. So what does that mean mathematically? Well, if you tally the taxes that Claude and his spouse would have to pay, these are Ontario rates, you end up with $44,000 and change for the couple. But if Claude did not income split and took the full $170,000 pension onto his own personal tax return and paid tax at the personal level, the tax bill would be $59,252. So just by papering the pension and doing it through pension income splitting, this couple is saving over $14,000 each and every year that they're using the pension income splitting rules. Now, you might be wondering, gee, this is a good deal. How soon, how early can I start pension income splitting? The answer is age 50, and it's important to remember that that's 15 years sooner than what you can do with a RIF. So if this couple did this for 15 years, well, that's $220,000 of taxes saved by the couple that's generated simply by using pension income splitting sooner than using an RSP RIF. Okay, now what if Claude decides to retire on an RSP? Claude ignores Stephen's advice, doesn't do the PPP, sticks to the RSP, maximizes every year, and the money grows at the same rate as if it were in a PPP. What happens? Well, the answer is at age 71, he would have a little bit over $3 million to retire on. So what kind of pension can you purchase with that RRSP at age 71? So if you use the annuity purchase rates for RIFs at age 71, the $3 million translates in a $240,000 annual pension. But if instead you had used a PPP, again without using terminal funding, just the natural accumulations, then that annual pension is $328,000. So that's a $87,000 extra benefit that the PPP client, or 36% more, over what Claude would have been able to achieve using an RRSP. But remember that this $87,000 extra is done without having to pay for it, because the program is already self-financing. The tax savings, and we've looked at various different types of opportunities, those tax savings pay for the annual fee many times over. So this is all net of any fees. So to conclude the case study, chapter 2, what has happened here is that by upgrading from an RSP to a PPP, we've been able to increase Claude's standard of living by 36%. And we've done so by already looking after the fees. So we don't have to find money to pay for the fees because that's already taken care of. We've also done it without taking any additional market risks. We wanted to use a 5% rate of return assumption, and that's what we did for both types of plans. In the process, we've also better credited protected the assets, because pension legislation offers special protections against creditors that you cannot find with RSPs in certain provinces like Ontario. And finally, we've been able to save the company a lot of taxes along the way. Remember, the terminal funding alone was a $266,000 tax savings, and of course all the other ones that we talked about. All right, moving on to chapter 3. So chapter 3 is how can you use a PPP to your advantage in situations where we have stock market corrections. How to better leverage turbulent markets using pension rules is really the subtext. Now, as discussed earlier, the CRA has approved the PPP. It's never been denied full registration, it's never been audited, and never been challenged in tax or regular courts. So what I mean by PPP is I mean a triple account combination structure. So it's a registered pension plan that has 3 components to it. And the 3 components are listed here. So we have the defined benefit component. So everything an individual pension plan or IPP has, we have it. We just call it the defined benefit component. Then we bolted on a defined contributions component and an additional voluntary contributions component, or ABC. And it's the flexibility of having all 3 accounts working together that really increases the power of the PPP over all the other types of plans that exist under the Income Tax Act. So let's here talk about turbulent markets, market volatility, and let's go with an example. We have a personal pension plan that starts the year with $1 million in assets, and it's invested in the TSX broadly in a variety of stocks. And under the pension plan formula, normally the liabilities, meaning the monies that should be in the plan by the end of the year, should be $1,075,000. That's because of the 7.5% assumption that's found in their income tax regulations. So graphically, the green line reflects the liabilities. So we're expecting the assets to go from $1 million to $1,075,000. But what has happened though is that we are facing a market correction. So on March 23rd of this year, a lot of assets lost about 40% in a single day. Now, because the PPP relies on pension legislation, we have the ability to file a special, what we call an ad hoc actuarial valuation report, to crystallize this deficit. And because we've declared that there's a deficit, now we have the legal right to make special payments from the company into the pension plan that are tax deductible, of course. And those special payments then allow us to go bargain hunting. So let's look at how this works in practical terms. And here's a standard situation where you have an operating company, OpCo, that's owned by a holding company, HoldCo, and OpCo decides to sponsor a PPP. Now, normally, there might be cash in OpCo, but usually what has happened over time is that OpCo pumps this cash, these retained earnings, up to HoldCo in an intercorporate dividend, so it's tax-free. And then HoldCo will be investing the monies that were generated by OpCo over the years in various passive corporate investments. The problem with that, one of the problems, is that, first of all, corporate passive investments are taxed at a high rate. But moreover, once the holding company generates more than $50,000 of passive investments, for every additional dollar of passive income generated, OpCo's $500,000 small business allowance limit gets eaten up by $5. So eventually, OpCo starts to pay more and more corporate tax. Its corporate tax jumps dramatically because of the passive income that's earned by an associated company, meaning HoldCo. So that is the problem with most businesses that are structured this way. Now, remember that we said because of the market correction, the pension plan went from $1 million to $600,000. So there's a $400,000 special payment owing to the pension plan. So what we do is we take that cash and we lend it to the operating company. One of the nice things about this is that the interest that's payable to HoldCo on this loan will be a new tax deduction for OpCo. But more importantly, it reduces the passive income taxes payable by HoldCo because HoldCo no longer has those assets. They're going to be inside the pension plan. So it removes a lot of assets that would have been exposed to very punitive taxes. It also reduces the risk of the 1 to 5 small business limit grind that we talked about earlier, because the monies are no longer with HoldCo or even inside of OpCo. So therefore, we can't have this reduction of the $500,000 small business limit for OpCo. So the way we do it is we inject that $400,000 that was lent by HoldCo into the pension plan. What that does is that it creates a tax deduction inside of OpCo, which is nice. But perhaps more importantly, the $400,000 is now growing tax sheltered inside the PPP instead of being punitively taxed as passive corporate income inside a HoldCo. And now, perhaps more importantly, the PPP can go bargain hunting because the securities that had lost 40% in a single day won't stay at that level forever. So as the assets recover, by having purchased at a low price, and now the securities are worth more, means a large profit. So what are some of the options once you've done that? Once you've taken advantage of a tax deduction and gone bargain hunting and the market recovers, well, one option is to do some profit taking along the recovery curve. So we can use the cash that's generated by selling the shares that we purchased at a bargain. And with some of that profit, we can purchase more low risk interest-bearing investments that will allow us to repeat the cycle, because we know that the inherent rate of return on those will be less than 7.5% generally. Or if we don't want to take profit taking along the recovery curve, and remember this is done in a tax deferred manner because all the profits are generated inside of a pension plan. So there's no tax on those profits. So, and as an alternative, we can just hold for the long run to see if the recovery is sustained and just get higher and higher tax returns. But if we miss the boat and the markets correct again, unlike everyone else in the RSP who can't do anything about it, we could crystallize the new deficits and transfer even more taxable money from either OpCo or HoldCo into a tax-sheltered PPP. So to conclude chapter 3, what have we been able to do here? Well, the PPP has allowed us to top up in an extremely tax-efficient manner, even though the markets were corrected. It also allowed us to buy the dip using tax-assisted dollars. And all of the profits that we might be taking along the recovery do not generate any tax consequences because the PPP itself remains tax exempt. But perhaps more importantly, from a large big picture point of view, instead of facing punitive passive corporate income taxes on the capital that was invested in the holdco or even in the opco, the PPP client is growing that capital inside of a tax-sheltered pension plan. So I'm going to leave it here for Stephen to come back to us with some final comments.
Thank you, JP, for your enlightening presentation. I'm sure there are many people watching out there who are wondering why they didn't know about the advantages of a personal pension plan before today. Not surprising. The Canadian Tax Act is over 3,000 pages long. Pension lawyers go to school for years and research for years to become experts in Canadian pension law. Doctors and dentists and others go to school for years to become experts in their professions. Being an expert in cardiology or implants does not make that person an expert in pension law. In the next 60 days, you can decide to adjust the investment strategies that haven't worked nearly as well as you had hoped they would. You'll finally be able to sleep better at night, knowing that you'll be maximizing your retirement account and maximizing your tax savings and receiving proven, reliable advice from professional pension lawyers. You'll be on your way to a proper retirement plan for you and your family. And what would having a consistently growing retirement account mean to you? Let me flip the question. An even better question is, how much is it costing you knowing that there's a much better way for you to grow the largest retirement nest egg as possible and claim the largest tax deductions as possible? Now, this is only for people who are actually serious about increasing their retirement account and significantly reducing their taxes, who are committed to improving their retirement accounts the right way with the right blueprint with a CRA-approved personal pension plan, and who are willing to follow directions from expert pension lawyers that make good sense. If that's you, then book a call with me today to find out if you qualify and if we are a fit to work together.